Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back, everybody. Seems like this past week was just slow. Actually, it is pretty slow. The volumes on stock exchanges around the world tend to slow down quite a bit during summertime. And the busiest time of year happens to be right around September. I know a lot of people who maybe, if you were born before 1975, which means you're old like me, and you remember people talking about the Great Depression and how October is the worst month in the market. And if you weren't born for that time period, you're probably not really aware of it. But it was kind of funny when I first started in the industry. Everybody just held their breath every October. That was the big day. The stock market dropped once 11% back in the late 20s, and that was the beginning of the major depression, as they called it, or that's what one of the things that kicked it off. And they were able to, you could buy stocks back then by just putting 10% down, and kind of like buying a home. You know, you buy this stock, they would let you put 10% down, and you owed 90% on it. Well, when the market drops 11% in a day, there's a pretty good chance that not only did you lose all the money that you had put into the stock market, but you actually owed 10% more than you had. And yeah, not a good idea. So that caused an unbelievable amount of problems. Banks folded all over. People had to sell their houses. The banks couldn't collect the mortgages, and it just led to a huge mess, financial mess. And the chances of that happening again today, I'm going to tell you, they're close to zero. They're literally close to zero. We have so many things in place now, and just like this debacle that happened a few months ago, that a bank went belly up. That was the same thing that happened on a much larger scale in the 1930s. Banks were folding, and people who had money in the banks, and you had more than they were insured for. Actually, most of them didn't have insurance back then. The vast majority of them did not have insurance. And they didn't have networks where you could buy treasuries directly through your bank, which would have not been affected by that. So anyway, I'm going on and on about a lot of stuff that probably doesn't interest a whole lot of people unless you are like older, but that's okay. I'll bring us right up to speed to where we are today. So today, you've got 10-year interest rates, 10-year Treasury rates that are 3.74 was the last value on the last closing trade. So 3.74% is where they were, is where they are currently. If you go back just to 2020, those were 0.62. That's a huge move. Over that short of a time period, that's a gigantic move. And people are thinking that maybe a recession is going to come because the Fed may continue to raise interest rates as quickly as they have. And along those lines, I got an article that I sent out to my clients and people who have gone to my website and requested to be on the newsletter. It's free. We send it out. I send it out. I try to get it out every other week. Sometimes it'll be once a week. Sometimes it's once every 3 weeks. It depends on what's happening in markets and how interested I think people might be in some of the information. But I thought this was a good one because it was an article that was posted in the Wall Street Journal at first. I had to license this, by the way, before I could send it out. And the headline was, "Could a recession still be years away? Steady growth, moderating inflation, improve odds of extended expansion." Wow, that's what caught my attention. You've been hearing a lot about recession, and the economy's already slowed down quite a bit. Most of it was probably caused by the pandemic. When you start shutting down shipping lanes, that has a tendency to affect pricing on the products, goods, and services that are being imported. And we import an awful lot of stuff here. We also export a lot, by the way. It's not as gloomy as people might think it is. I hear this all the time from conversations I have with people that listen to the show or just clients. And it's nowhere near as gloomy. We export a ton of stuff in the United States. We import a lot as well, and we produce a lot of what we consume here. So anyway, back to the article. Could a recession still be years away? Steady growth, moderating inflation, and improve odds of extended expansion. I thought that was interesting. Anyway, it goes on to say, economic expansions don't die of old age, economists like to say. They are murdered by the Federal Reserve. That's the very first line of that article. And I missed that when I read it the first time because it was above a picture and I didn't take time to look at it. But anyway, that's pretty good. The article goes on to say, well, no wonder then that the Fed has raised interest rates 5.25 percentage points since early last year, including a quarter point Wednesday. Forecasters have predicted a recession was imminent, but they have postponed the recession start date as growth remains steady. Now, by the way, I'm going to tell you that these guys are forecasting and trying to give you dates because they know that you'll listen. They know that you'll read, that catches your attention. They also know it's impossible to get that with a high degree of accuracy. They know that. But if they don't tell you that it's going to happen at a certain date and a certain time, because that's what the public demands, we want to know. We want to know exactly when, how much, and they just don't give up. No matter how many times they're wrong, and these guys know now that you will read this, and they get paid for views on a web page. So this information, you've got to really take it with a grain of salt. So anyway, the article goes on and says, but they have postponed the recession start date as growth remains steady, whatever that steady number is. The economy grew at a better than 2.4% annualized in the second quarter, the Commerce Department reported on Thursday. 2.4% is okay. It's actually significantly higher than that if you look back historically. But if you take out the 70s and 80s, that's probably close to where the average would be. Anyway, actually, in one respect, a recession in the next 6 months would be unusual. It would mean the current expansion, which began April 2020, will have just lasted 4 years. That's less than the 8.6-year average of the 4 prior expansions dating back to 1982, which is all fine and dandy, but stories are always changing. So just, again, take this with a grain of salt. But it is good that it appears to be good news, because the good news gets passed around pretty quickly. People are looking for it, and it helps. It helps with the psyche of investors. And investors control markets. It's their activity. Are they buying? Are they selling? Are they raising? When they sell, are they putting the money in cash? Are they buying bonds? Where's the money going to go? and your guess is probably as good as a lot of the major forecasters on a short-term basis. On a long-term basis, it's a whole lot easier, and that's why I always recommend to people when you're looking at your investments, try to think out at least 5 years, and 10 is a better time period. And if you're looking at 10 years, do you really care what happens in the next 6 months? I mean, you might, because you might be an obsessive worrier, but if you give yourself 10 years and you're managing your money that way, I don't really have to do anything different for the next 10 years. And you can relax, and you can actually ignore these articles because it's really not going to matter. And over 10-year time periods, the market's been higher, if you look at rolling 10-year time periods, more than 90% of the time. So the probabilities are in your favor. And if you have money in fixed income, and I'm going to tell you right now, fixed income is not bad at all. We'll talk a little bit more about it later in the show. But fixed income, I'm looking at a fixed annuity that's guaranteeing an income. And this is somebody who's 66, is going to be 67 a year from now, so we'll start to draw Social Security. They're retiring. For every $100,000 that they would invest in one of these annuities, it would give them $7,154. That's pretty good. That's actually really good, and that's guaranteed for the remainder of your life. And if you pass away early and haven't spent down money in that annuity, they will put whatever remains. They will give it to your beneficiaries. So that's a good deal. From a fixed income standpoint, I think it's a great deal. From a stock standpoint, where should you have your stocks? What should you have them invested in? I am a big fan of using exchange-traded funds. I'm going to tell you why. And this is one of the things that kind of kills me about the industry, and not the industry, but people in general. I can't tell you how many people think that all exchange-traded funds are the same. I mean, I'm I'm just flabbergasted. What you think they've got over 3,000 funds out there that are all buying the same stuff? Well, yeah. Okay. Well, that's not how that works. But anyway, there are lots of differences, and I know that those are anomalies, thankfully. I mean, it's not like 30 or 40% of the population thinks that way. It's more like 4 or 5%, which is still kind of a lot. That's like 1 out of 20. But anyway, makes my life a little challenging occasionally, because oftentimes the people that think that way they're very stern in their beliefs and their ideas. So I'm just here to tell you the best of my knowledge and try to help you out the best I can. Sometimes you just can't help certain people, and that's fine. But bottom line is how your stocks are built, or your funds are built, the characteristics that they focus in on, and how do you find that out? Well, you read the prospectus, and in the prospectus, it'll tell you what their philosophy is and how it's going to be executed, and that matters. I mean, it matters a lot, and there's been it's slowly been changing over the past 5 and 10 years. Past 10 years, the amount of change that's gone is incredible. They're still changing. It's just not as fast of a rate as it was 10 years ago. It's starting to slow down. So you got all these funds out there, and you really need to read the prospectus if you're going to pick these yourself. And it's one of the reasons I still have a job, because I don't know if you've ever read a prospectus, but get ready. By the way, if you are an insomniac, get yourself a bunch of prospectuses and put them on your bedstand, on nightstand rather. You will soon be going to sleep faster than you ever were. But there is important stuff in there, and it is really important that you know it, because it's going to have a major impact on how the money is being managed inside of your investments, and that's a big deal. And they're doing very well. I mean, the choices that you have out there, the selection, there's some really good ones. And I think I'm going to have to take a quick commercial break here within the next minute or so. But so I'll just go and promote my company again right before these commercial breaks. This is Bill Bullington. If you haven't listened to this show before, welcome. If you have, thanks for tuning back in. Last week I got 2 really nice emails, and I'd like to thank those people for being long-term listeners. And so that's great. And my website is bullingtoncapital.com. If you hear something that you'd like more information on, if you'd like to talk to me about your own personal situation, feel free to go to my website, reach out there. I'll get back to you as quickly as I can. And there's no cost and no obligation, and there's no pressure. The tone of voice you hear me taking now is the same tone of voice I normally use, maybe a little less animated, probably actually a lot less animated. But anyway, I got to take a real quick commercial break. This is Bill Bullington right here on 1420. Stay tuned. We'll be back after these messages. Oh, welcome back. Commercial messages. Bill Bullington. I'm here every Saturday morning from 11 to noon. You can reach me by going to my website if you'd like to. It's bullingtoncapital.com. And there's a contact us page there. You can also call us, 330-664-0700. That's 330-664-0700. And we'd be glad to try to help you any way you can. If there's something that you'd like more information on, feel free to call about that. We just kind of bounce around in various topics here. I like to do that, by the way, because that's how my mind works. One thing and then another. But actually, it almost never turns off, but not sure how good that is. But it is what it is, I guess. And we were talking a little bit about the lifetime or guaranteed income for a minute there. And I use a product, and I can send you a link, by the way. If you want to go to my website and say, hey, Bill, send me that link on the guaranteed lifetime income product you're talking about. It's from Nationwide. Out of all the hundreds of products I've looked at, I like this one the best. And there are lots of reasons for that. This one's not necessarily the highest paying. I think the highest paying one's probably 0.5% higher, some ridiculously low dollar amount. And the company doesn't have the ratings that I look for. And anyway, so with this particular, just an example, say somebody is 66 years old, next year they're going to be eligible for full Social Security. Okay? And they decided, yeah, I've had enough, I'm packing it in. So I would like to have a certain amount of income guaranteed. And you can go to the website, you can put your age and the kind of income you want, and it'll tell you how much money you would have to guarantee that portion. And I just went in and put in $100,000 as an investment. But okay, what will that generate? Just so that I can keep the math kind of simple and it's easy to understand. So if somebody did that, they were 66 and they're going to retire next year, full Social Security age. So they got a year. And that's how that product works, by the way. There's a 1-year period they have to go before you can turn the income on. So that $100,000 would guarantee $7,154. That's a lot. I mean, I think it's a ton. We're just talking about 10-year treasuries that are paying 3.72. And I know right now there are short-term CDs that are paying more than 10-year treasuries are. That's called an inverted yield curve. It's when the short-term treasuries pay more than the longer-term ones do. And that normally accompanies or actually precedes a recession. That's why people have been talking about it for so much. But it precedes the recessions because it's actually has been in the past, it's been a major cause of recession. So when they start raising interest rates, the interest rates on car payments go up if you're buying a new car. House payments go up. Some people don't even qualify anymore because the interest rate, they were close to the edge with a house that they were applying for financing for, and then they raised interest rates, and it pushed them out. They weren't able to get the loan anymore because the payment was too high of a percentage. Now, that hasn't happened very much at all lately, but it could potentially, and I'm sure of it. I mean, I know there are a lot of people who were looking at houses a year ago or a year and a half ago, and now they don't qualify for the same level of financing that they would have been able to get. So that slows down the economy. Banking and home building makes up more than 25% of the economy. That's a lot. So when you when you slow that down, that's one of the reasons that everybody's been calling for these recessions. And it's also one of the reasons the 10-year Treasury hasn't gone up higher. And more than likely, the 10-year Treasury, people that invest out that far, didn't believe that it would keep going up. And so the bonds didn't drop as much. And they were content with that kind of interest rate, at least for now. These are not mom and pop, by the way. These are big institutional investors. The mom and pop are buying short-term CDs, and I hope that the rates don't drop and go all the way back down to 1% again on short-term CDs. See, that's the risk with short-term CDs. At the end of the period, at the end of the 1 or 2 years, if the economy does go into recession, the rates that you're going to renew it are going to be a lot lower than the rates are now. And that's the tough thing about short-term anything when you're looking out over the short term. So the rates that you're seeing today are probably, if they do accomplish slowing the economy down, if inflation starts to subside a little bit, and at some point in time it's got to, then short-term interest rates are going to come down. And if you're going to be 67 next year, you're looking to take full Social Security, and this will actually more than pay for most people's Social Security supplement, which I thought was a good idea. I got this idea from a client, by the way. I didn't get his permission to use his name, so I can't mention that. But I thought it was a great idea. He said, "How much money would I need to pay my Medicare supplement?" And basically, what he did, he just put together an annuity, and it's paying. And by the way, more than one person's asked me about that. Quite frankly, it's probably at least a dozen. And I'm like, that's actually a pretty good idea. Yeah, you set this up, and it's going to pay. The thing you have to be on guard against with that, by the way, is that the payments on Medicare have a tendency to go up over time. So you might want to take that into account. If depending on the type of annuity you get, they don't actually increase. Some of them will go up with inflation. Most of them do not. So you probably want something that's paying more than what the current cost is, so that over the next 5 or 10 years, you're not having to supplement that out of your other savings, if that makes sense. So, but anyway, $100,000 in 12 months from now can take out $7,154 a year. Every year that you would put that off, if you had the ability to put it off, the guaranteed income, lifetime income goes up. So the original guarantee was $7,154. Year number 2, it's $7,824. Year number 3, it's $8,541. See, it's going up every year. The guaranteed income goes up each year that you postpone it. And they give you a schedule, and the insurance company guarantees that schedule. So if you waited 3 years on the $100,000, you'd be getting $8,500 a year instead of the $7,100. And that's great. It gives you some more predictability in your lifespan, I guess I should say. I got stuck there on a word for a minute. It reminded me of Mitch McConnell. Anyway, hopefully I'll never get that bad. But he's old, though. I'm surprised how old the Congress and Senate is. that. It makes me feel better. It makes me feel young. But anyway, I won't get off on those subjects. But so somebody who was 66 today, 3 years from now, could get $8,500 a year in income. Now, if the investments inside of it grow faster than, and if the value went from 100 to 100 over 151,000, that number would actually be higher. The chances of that happening are not good. Okay, so I hear all these guys talking about these products all the time, and they emphasize, well, yeah, but it's invested in the indexes, and if the indexes, you know what? Yeah, I might run a 4-minute mile too. I wouldn't bet on it. Just like I wouldn't bet on the Browns going undefeated and winning the Super Bowl. Okay, those things are probably more likely than this is to keep up with the income value that they generate the income off of. In other words, stick to the guarantees. That's probably what you're going to get. 9 out of 99 and a half out of 100, that's my projection on that. The guarantees that you get will actually be better than the performance on the underlying investment. And that's one of the reasons that I wanted to use it. I'm telling you, I see things happening all the time. I see people investing on their own. They're not keeping up with the indexes. They make bad decisions because they get emotional. I mean, it's been tough. The last couple of years have been incredibly tough. I'm looking at the chart. I'm going, wow, this is kind of nuts. And in fact, if you were in some funds, some index funds are down. Yeah, this is amazing. This is the Russell 1000 Growth Fund. You keep hearing, market's up this year. Yeah, but it's still below the level it was 2 years ago. And it's very confusing. It makes people think that they're missing out somewhere. It makes them make bad investment decisions because now they're troubled over the fact that, well, the market's at a new 1-year high. Well, yeah, but see, the all-time high actually happened in December of 2021. And nobody's telling you that because that doesn't sell a lot of ads on television or in the newspapers or magazines. So give yourself a break. Try to look at this. One of the reasons advisors still have jobs, because if you left it up to the media to tell you how to invest your money, it wouldn't be good. And they do have a tremendous amount of influence, and I will tell you the vast majority of it is not good. You have to look into the message and who's telling the message, and it makes a big difference. By the way, it helps if you deal with a fiduciary. A fiduciary is somebody who has to legally operate in your best interest. Okay? So we are fiduciaries at my firm. We do get commission on some things, not many, but we get commission. We have to tell you everything. We have to show you all the expenses, all the funds, and everything's out in the open. If you're not dealing with a fiduciary, it's not that they're necessarily all bad. I don't believe that for a second because I know too many of them. But there are things you should look for a fiduciary. Let me just put it that way. Try to find somebody who's a fiduciary. And almost everybody has it depends on the structure of the products that you're investing in. But I'm not going to bore you with those details. Just try to stick to people who are fiduciaries, who are legally bound to operate in your best interest. It's better for everybody. So, I'm just looking at this graph on a 10-year bond. It's unbelievable how much the 10-year bond yield has fluctuated over the past just few years. It was 3.15 in October of 2018. Now it's 3.14, but it was down to 0.62. Yeah, that's a big move. That's like going from 300 to 6. That's a lot. That's really a lot. But anyway, now it's back up to 3.74 or 0.6. I'm sorry. It's a just gigantic moves. We're not used to seeing moves like that. That especially in fixed income, it's been happening more frequently. So again, it's something that you just want to have some conversations with people to get a shorter guarantee period for like treasury bonds or CDs. The problem with most of those are going to be at some point in time they will succeed in causing the recession. It's just part of the economic cycle, just the way it goes. So we go through a recession, they will be cutting interest rates again, and those short-term CDs are going to come back, and they're going to be a lot less than what they are now. So that's one of the reasons I like to talk about the fixed index products, because they're guaranteed for the remainder of your lifetime. Right now, the guaranteed levels, they're actually pretty high. I'm surprised that they've stayed this high, and that's shocking, actually. I think it's a good place to be for now. If you don't need to take the income, you've got a schedule that's guaranteed. It's going to go up each year that you decide not to take the income, and that's pretty good. So if you want to hear more about that, just give me a call or reach out, Bill at BullingtonCapital.com. I know I'm killing all the people that that want me to talk about just stocks, and I feel bad about that. We are going to get to stocks. Actually, I'll start to talk about them. The last section of today's show, which is going to happen right after the next commercial break, which is somewhere, I think we've got about 9 or 10 minutes for that next commercial break, but I will talk about it because it is interesting. There's been changes, and just in how many companies are actually participating in the rally, which ones are participating in the rally, which industries or sectors are still looking attractive from a growth standpoint. We were talking about that just shortly during the show about how exchange-traded funds select the stocks that are in the fund. The vast majority of them are not done by humans; they're done by computer programs, which is it's fine. It's actually like their checklist. Think about it. How much better off would the world be if people got really good at using checklists? And I got a book on checklists from, I think it was a Checklist Manifesto or something like that. And I've read about half of it, and I'm always trying to read. I read so many books at one time. I'll do 2 chapters on one book, put it down, and pick up another book the next day, do a couple chapters. So I'll get through it eventually. But the book is basically about how people who are extremely detail oriented, things like brain surgeons, they have checklists they have to go through. At least you hope they do. But airline pilots, they have checklists. People that own businesses, they have checklists. They write these things down to keep themselves organized and keep themselves from doing something that they shouldn't be doing. And I go back to the checklist. So with a checklist on stocks, I'm going to tell you what my checklist is. That it helps me look into the stock market to see which stocks are moving now and why. I can tell you why. Normally the sales and profits are rising. That's part of the checklist. And one of the reasons I used exchange-traded funds is because they publish their checklist. They call it investment strategy. And you can read about it, and you can see which attributes they're looking for. Like some might have companies that have dividends from companies who have a certain amount of profit being generated. Because if you're paying dividends and you don't have profits, that's a problem. Sooner or later, you're going to have to cut that dividend. And we're going to have to come back to all this stuff in a few minutes. I just got a notification. I got to take a commercial break. This is Bill Bullington. I'm here here every weekend on 1420. I'll be back right after these commercial messages, so stay tuned.
All the things that I've held dear, the vanities voice that whispered in my ear.
Welcome back, everybody. If you're just tuning in, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you hear anything you'd like more information on, feel free to go to my website. It's bullingtoncapital.com. There's a contact us page there. I'd be glad to forward any information or try to answer your questions. You can set up a phone meeting if you would like to do that. It's free, and just reach out, give me a buzz. We were talking a lot about a whole bunch of different things today, which we do on almost every show. And we started off talking about recession and trying to predict recessions. And I forget. Yeah, so I majored in economics in college way back in the day. And it was funny because professors some of them were pretty good about it. They laughed about how difficult it was to make predictions, and I remember the old joke being one of the jobs of economic forecasters was to make fortune tellers look good. And it's still that way. I mean, when you look at how many things are happening and going on and how the world changes and how many things that weren't relevant 10 years ago are all of a sudden relevant today, it's an ongoing thing. And most of it, I think a lot of the people in the industry agree, is, you're looking at what's happening right now, and you're trying to make adjustments to what's happening right now. And when the future changes, you'll make adjustments again. And an awful lot of people that read the material, though, are looking for predictions that they can count on. I remember back in the financial statistics courses, there's very little likelihood. They taught us in probabilities. And what are the probabilities? So they're pretty shrewd, and it's generally the public that doesn't invest a lot, that doesn't realize that you can't make predictions that are going to be extremely highly accurate for an extremely long time period. Inevitably, at some point in time, something's going to happen that you don't expect. Okay? And that's one of the reasons that you want to have some fixed income in your account, something you can count on. If I knew I was getting, and I've got the product that I was talking about, and I know exactly what I'm going to get when I'm 67, and it doesn't matter what the stock market does. And the returns that I would have had to earn in the stock market, the vast majority of people in this country don't make in their stock portfolios. That was the key factor for me. I looked at that and go, hey, wait a minute. I mean, and there are years where my performance has not been as good as that is because the market collapsed, and I've got a ton of my money in stock funds, not as much as I used to, but I had a whole bunch more back then as a percentage of my total, and I had to write it out. Didn't have a choice. Actually, I just kept adding to it, so it did come back a lot quicker than it would have had I sat there. But what do you do when you're at retirement age and you're taking money out and you can't afford to keep putting money back in? That's what I'm talking about. This is a timing issue. So the closer you get to having to rely on taking that money out, maybe you're already there, the more financial security you're going to need. You're still going to need stocks, and I would recommend an ETF portfolio that's got a really good diversification that focuses, by the way, on those two factors I kept telling you I was going to talk about, and I forgot. the two factors that are the most important are size. Unfortunately, that's not my favorite one, by the way. So just how big is the company? The bigger ones have a tendency in the last 10 years to do better. There's a reason for that. In the long run, the medium-sized companies actually have the best 40-year track record. But anyway, size is kind of key. You don't want to go too small, and you can go as large as you want, but you want size, you want profitability, and speed. Those are the three main characteristics. Now, they use a bunch of 3- and 4-syllable words to describe all that in the fund's explanation of how they're investing the money, but that's essentially what they're focusing on: size, profitability, and speed. Okay, so if those are the characteristics in the ETFs, that's going to narrow down the list of ETFs that you have to look at by a mile. Okay, so again, if you got any questions on any of this, feel free to reach out to me. But even if you do a good job, you can actually, I have a caller. I don't know who it is because I'm doing this broadcast from home, but all right, so it is Chris. Chris, hey, you're on the Bullington Capital Report.
Yeah, I just have a question on national debt. Since they've signed the last agreement to lift the cap on our national debt, in 6 weeks it's gone. They've exceeded it by $1 trillion now. And at what point does the national debt become a problem? We're at $32 trillion. We'll probably be at somewhere over $40 trillion by next year. And I assume in the next 5 years we'll probably hit $60 to $70 trillion.
Right. Yeah, it's been a long time since I've looked at the debt. Here's what I would tell you, though. We're probably getting close to the level that we were at right after World War II. And at the end of World War II, we were about 145% of GDP, almost 150%. Yeah. And that was the highest level. That's the bogey. Okay, that's the benchmark. I don't know where we are today. I'll have to look it up when I get off the
I think it's about 120 or so. 120% of it.
So,
yeah, 120.
Oh, okay. So we would still be below, if it is at 120, we're still below where we were after World War II. And you know what happened to the economy after World War II, right?
Yeah, but you had a baby boom. We don't have that anymore.
We've got the baby boom increases demand, correct?
Yeah. Yes.
What do kids do when they get out of college? When they buy a car. They want to live in nice houses. They got iPhones that they're paying us, over $1,000 for. The demand is kind of there anyway, and the population growth is not. Most of our population growth has come from immigration in the past 15 years anyway, and people moving to America. But so you've still got a pretty decent population growth. It's not natural. I mean, it's not people having babies, but about a third of it is. But my point is that
that's a population growth that has to be taken care of, as opposed to a population growth that's part of a nuclear family.
Yeah, you're going to have both in there in all population growth, and a lot of those people work really hard, man, and they don't make a lot of money.
And I understand that.
Yeah.
I guess my concern is I don't understand. At what point does the national debt just destroy everything? I mean, and where do you put your money? I mean, if the national debt just keeps going out of control.
Well, if it gets like super high, like if we become Argentina, the best thing to hold on to is going to be short-term cash. The interest rates on money markets will be like they were in the 1980s. I remember them being 18% at one point in time.
Yeah, I agree.
Percent.
Well, prime rate hit 24.
Yeah, so we'll probably be back to that situation, and your best investments. And this is one of the reasons, by the way, in my practice, the fixed income that we hold, it has an average maturity of 1.8 years. Less than 2 years. And I've been holding on to this fund for well over a decade because that's what they do. And it's looking for shorter-term, high-quality, liquid stuff. And I didn't care when the long-term interest rates had an interest rate that was 0.75% higher than the one I was getting, because I knew, when interest rates do go up, those long-term bonds, and they came crashing down. They didn't come dropping down mildly and give you a warning that they were going to go down. Look at the TLT. That's the long-term Treasury bond fund. That thing is down 40% from its peak, and it peaked over 2 years ago. That is mind-boggling. So that's just been torturous, and it doesn't take a ton of skill, but it takes some knowledge of what you're talking about. How is the economy doing? How is it relative to interest rates? And where have we seen periods like this before in this country? It's never going to be exactly the same, by the way. And that's what a lot of novice investors have trouble with, and they make mistakes because they assume that something's going to happen exactly like it did before, and it never does that. There's always something that makes it a little bit different, and if you don't know what that is, it can end up hurting you. And we don't know what it is until it actually happens. So being too opinionated, in my opinion, is not a good thing. You have to be pretty flexible. And like I said, I'm not going to try to pick bottoms and tops. I'm going to try to be in the middle somewhere. Middle ground's a good place to be. If you can keep up with the averages, man, you're doing really well.
Okay. Hey, Bill, one thing on stocks you wanted. What do you think of AT&T and Verizon? Are they just? Everybody hates them.
Yeah, I'm not a huge fan, but I got about 20 seconds left of my show.
Okay.
I'll pick that. I'll pick that topic back up next week.
Okay.
Actually,
you got like 7.8% interest dividends on each.
Yeah.
So.
Yep, but some of them sometimes they're borrowing. Okay.
Yeah.
All right. Well, listen, thanks for calling. Yeah.
Bye.
Have a good weekend.
Bye.
And to everybody else, thanks for listening to my show. Bill Bullington, BullingtonCapital.com. Have a good weekend. Good luck. Good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.